Good evening, everybody. Welcome to this session, the Global Connections on Personal Finance. My name is Rodrigo Hernandez. I typically teach the personal finance class and on regular basis, the online MBA classes, investments and international finance. I also working in the last couple of years for Vancouver and Tri-City, filling some needs in intermediate financial management and financial markets and institutions. So you might have seen me in different places, but for the last year and a half, we started offering personal finance online, and I'm enjoying this a lot. So what I'm going to give you is an overview of the class, the personal finance class, in a very friendly way. Obviously, the class goes into a little bit more technical issues, but I'm borrowing this handout or like a guide from the Federal Reserve on personal finance and makes this very friendly, very simple. And I'm going to show you in a little bit how this guide in simple words correlates with the chapters we cover in the class. So this slide will show you exactly where the connection between these simple topics that sounds like common sense or average day topics and the chapters we cover in the class. Okay, so this is going to be just an overview. Hopefully you get something out of these and basic principles. Nothing too technical, obviously. And neither the class is too technical. The class goes over basic principles, and one thing for sure, this class counts as the quantitative component of the BBA. So there's a little bit of math, but it's not that that bad. Okay, so personal finance. So from the well-being for enjoying or achieving your goals in life, having your own house, sending your kids to college, and eventually having a good retirement, right? We need to start planning about all these issues. Some of these will be short-term, maybe the down payment on a house, that will be close or in 5 years or maybe a little bit more, but then sending your kids to college, and then retirement might happen around 40, 45 years after you start working. So all this requires decisions early in life. And even small decisions or significant ones like buying a house or buying a car, the more you know, the more you can do a smart decision, right? Because there are kind of tricks on fees and how you approach. We kind of also go through these steps of buying a house, buying a car, looking at mortgages, things that are going to happen to everybody. Student loans, credit cards, checking accounts, saving accounts, all different type of products you're going to get from financial institutions. Obviously, everybody will be exposed to these things. So we're going to organize this presentation, or I organize this presentation in a couple of sections, 1 through 5. First, a little bit of knowledge or language specific to financial planning. Then we're going to get into how to budget, how to organize your goals, budget, and then start saving to achieve these goals, and how to invest later, right? When you're saving, where to put your money to achieve your goal. Then in this process, you also need to use debt, credit. You're going to take loans to buy a car, to buy a house. You take student loans, you use the credit card, how to handle these and it doesn't get out of control. And finally, we also need to protect our wealth. As we get older, we're going to get more wealth. We're going to define wealth in a little bit. And we need to have insurance, life insurance, health insurance, property, liability, and finally estate planning. Okay, so here on the left, you have the sections of this guide put together by the Federal Reserve, called the Guide to Securing Your Financial Future, Building Wealth. And on the right, here you have the chapters of the book we use in personal finance. So you see, when it comes to the basic language, is the first chapter introducing the topic. Then how to budget. Well, first you need to put like a statement of assets and your income. Yeah, it's typical financial statements of a company, but on personal basis. An income statement of all your income and expenses, and a balance with all your assets, liability, and the net worth, which is the equity for a firm, and a little bit on taxes. And then when you start investing, we're going to go through basic investment principles, stocks, bonds, mutual funds, and then debt, in general, controlling debt, use of consumer credit, specifically credit cards, student loans, and the mortgages and car loans. And finally, health, life, property and liability insurance, and estate planning. Okay, so let's start with basic concepts, right? So like a firm, right? When we look at the firm and we study accounting, we typically learn when we study the firm that the balance has assets on the left, liabilities or debt on the right, and equity. So this is a basic accounting principle: the total assets, the total debt, and the net worth. So for an individual, that's it, right? So if you think about the total assets, we're talking about savings, pension plan like a 401k, stocks, bonds, a house, a car, a rental property, things that you may not have now, but later in life, you might have those kind of assets. Liabilities, any debt you have on the house, the mortgage, the balances on any loans like a car loan or credit card loans, medical bills. These are going to get very big at the end of your life, right? The older you get, the more expensive is healthcare. And then if I take the difference, I'm going to calculate my net worth, right? The difference between assets and liabilities. That's exactly my net position, my net worth on, let's see, I need to close this and then I can change. Oh, okay, so I need to remove everything before I can. Oh, I need to clear. There we go. All right, so we need to consider also the behavioral issues, right? Because spending all your income, right, all you make and you don't save, and it's not the smartest approach for these goals, right? For retirement, for sending your kids to college or buy a house or anything like that. So a good exercise, in the class, we do this exercise. We give cases like this. Anthony, 35-year-old, has this type of assets and certain liabilities. Figure out exactly what your net worth is. So we typically do this type of exercises without getting too sophisticated with assets and liabilities. But it's a good exercise to know where you stand, right? How much you have, and if it goes in line with your age, right? So here you have, from 20 years old to 80, the life expectancy, the average is 87 in the US. So as you progress through life, your goals will be changing, right? So imagine you start working in a few years. It's silly, but you're going to be spending on your first year a lot of money in clothes, in a car, in furniture, right? which most people don't think about that, but it's expensive, it's a significant investment, right? So you can tell, I mean, at the beginning is the car, clothes, furniture, then you get into, start thinking about the down payment on a house you might buy. And here you have your net worth over time, right? Until the time you retire, you're gonna reach the peak, and then you start withdrawing or consuming this wealth since you stop working, right? You're gonna live on your savings, your pension plan, social security. But as you go through life, there are different objectives or goals, right? So sending your kids to college in the 40s, 50s, 60s maybe, and start thinking about retirement, the sooner the better. We're gonna learn about that. Also, at the beginning of a course like personal finance, we also discuss the prospects of education and careers. And the example here might not be current numbers or most recent numbers, but it shows you that the higher the degree, the education you have, the higher the average income or earnings, and also the lowest unemployment rate, right? So education is the best insurance against layoff or poverty or, you know, those negative consequences. So yes, education helps. Not all the degrees, as you might have heard, or not all the degrees pay the same. I mean, there are some industries that are in high demand: computer science, programming, finance pays really well. We probably are facing, we are about to face a market correction or, you know, a recession in the next couple of years. We will have recessions every 5 years. I mean, one for sure every 10 years. So you need to also be aware of those turns, right? So we need to get ready for that. How you get ready? Well, anticipate. Maybe get more education, maybe get trained in the demanded skills, right? And also, we are going to point out that even on personal relations, right, on marriages, the finances can be a big deal, right? Can be the number one actually cause for stress or disputes or fights, right? So it's strongly recommended that in a couple that both understand the money issues, the savings, the goals, the financial goals, and whether you're making progress or not, whether, so a common understanding, even basic one, will avoid some issues, right? So in terms of, this is a difficult exercise. You need to set, take your time, think about what your goals are, and there's also a time frame, right? Some of these goals will be short-term, right? Some mid-term and some long-term, right? Here you have a couple of examples. Down payment on a house, build up an emergency fund, right? Emergency funds are those that if you have a visit to the ER, you have enough to pay the copayment, or if you need any treatment, you will have. Long-term goals like sending children to college or making a good living when you retire in a couple of decades, right? So yes, we understand these goals, but the most difficult part is to implement this, right? So these goals have to be realistic for sure. You need to have a time frame. You need to figure out a way to accomplish these. They have to be flexible goals because conditions change. So this is a more technical graph, but it shows the steps, right? So first you need to evaluate where you stand, right? So what are your assets? What exactly, let's see if I can graph. So step number one, evaluate your current situation. You're gonna put together like a balance, an income statement. You might look at ratio analysis and numbers and changes to exactly know where you are. Step number 2, you're gonna define the goals. What exactly are your goals? You're gonna try to devise a plan of action. The most difficult part is implementing it, and then you're gonna reevaluate this, right? So do I need to change, revise, update, or completely change, right? So it's a constant process of reevaluating where you stand, where you want to go, and whether you're making progress or not. So sometimes people will have to change their behavior, right? So some people have the personality to be organized, track spending, live within their means, stick with the budget, pay the credit cards on a timely manner, start saving, make contributions to retirement, and that will be perfect. Not everybody is like that, right? Some people go, doesn't understand how much they have, how much they spend, eventually pay fees for late payments or overdraft, right? So this, if you're among this group, you will have to take action, right? Start putting together like income statement or list of expenses, track day to day your spending, see the balance in your checking account, and monitor your debit cards, right? So you might have to change your behavior. Now, it's not an easy exercise. Let's say you figure out that you're not saving anything at all. So you develop a plan. For example, this is the case that you might be able to cut certain expenses, right? Like, what if you cut a little bit on the cable TV, on the clothes, on the gas, on meals, eating out, right? What if you come up with $125 a month? Well, that's a beginning, right? So with time value of money, with 20 years ahead of you before retirement, that can make a big difference, right? But if you don't do this exercise of tracking your expenses and putting a plan together, you're not gonna achieve any of these goals, right? So the next question, okay, so if I come up with the 125 every month, what do I do with this money? Should I put it in the checking account, saving account? Or as you get more knowledgeable, as you know more about these vehicles, there are certain vehicles that have certain tax benefits. For example, the retirement plans, or Roth IRAs or IRAs, or stocks, bonds, mutual funds, right? So what's the best choice? Or maybe canceling certain debt. I can reduce my balance, the balance on the on personal loans or consumer loans or credit card, right? So then you start saving on interest or fees. And some tips, try to do this every month, maybe pay deducted directly from your payroll check, and keep track of the, if it's automatic, it's much easier, right? So if it's taken directly from your payroll check, or it's automatic deduction from the checking account, that's even better, right? Otherwise, you have to make the deposit or transfer all the time, right? And maybe it's less likely to happen than if you make it automatic. All right, so where do you put the money, right? So this is where you need to start considering bonds, stocks, different alternatives. But first of all, you need to understand the principle of time value of money. Time value of money means that when you deposit, let's say $100, you're gonna get, let's say, a 6% interest over, let's say, 1 year. Okay, so then you have let me write here, let's see if I can. So this is your 100. After 1 year, you also get $6 interest. The next year, you get the original 100. You have the $6 for the first year, the $6 for the second year, but also you get 36 cents, the blue line, the blue part, which is interest on the first 6. This is called interest on interest. This is called compounding, right? The benefit of earning interest on interest. You see, start to have like a quadratic function, right? It's growing faster than straight line. A straight line will be more of a line right here. A straight line will be something here, the red part, right? So including the blue, the interest on interest, benefits on your previous benefits, right? Return on previous returns. The money is generating money, right? So it's growing faster. And that can make a huge difference, right? So you invest early in your life, and after 20, 30 years, you will see that the balance on your retirement fund grew significantly, right? Obviously, that the higher the interest rate you get, or the higher the return you get on these investments, the higher the future amount. So here you see at different interest rates, the amount is growing faster, or the balance is growing faster, right? So in a class like Finance 223, Personal Finance, we are gonna teach you basic things like time value of money. What's the future value if we invest at 6% over so many years? So here is like 125 on monthly basis, after 20, 30, so many different years at different interest rates. We learned that. We also learn how to move cash flows around. So for example, here, we get $500 every year, and we wonder what's the future value at the very end. How much money would I have at the end of 5 years? This is called future value. Or if I get the $500 in year 1, 2, 3, 4, and 5, what's the present value? We use this a lot in finance because we need to figure out a place where we put all these cash flows or dollar amounts at the same place, right? So we bring everything back to moment zero, and we call it the present value. That allows me to compare things because they're all in dollars of the same year. So this is the most quantitative part of the class, when we calculate future value, present value. And this is the math, the chapter about math, right? And that's why it meets the requirement of quantitative. We also going to do a little bit of calculations on the taxes, the basics of the federal income tax or state income tax. There's a significant amount of misconception. For example, if let's say let's make $100,000, right? So you fall into this bracket, right? The bracket of 28%, but you don't pay 28% on all $100,000. So how it works is that on the first 93.25, you don't pay let me see, 10%. Yeah, on the first up to 9,325, you pay just 10%. Then between 93.25 and 37, which is around $28,000, you're gonna pay 15%. Then when you get from 37 to 91, we are talking about almost $62,000, you pay 25. So the more you make, the more you pay on the additional dollars, right? So it goes by brackets. But it's not that you apply 28% to all the $100,000 income, right? So we need to teach you the basics of the federal income tax calculation. So we are gonna get a little bit into the details or the steps of the tax return, right? On very general terms, but we need to tell you the mechanics of the income tax, all right? So what exactly goes into the gross income? What exactly are the deductions or expenses? Then if we use itemized deductions or standard deductions, and then some exceptions and income is not taxed at all, then the tax bill, tax credits, and eventually how much you need to pay or tax return you get, right? So it's important to understand the parts of the tax return or the tax calculation, because you might want to change your approach, the way you handle your business, right? The way you have your income or expenses, or maybe make a company. I mean, we learn about all these parts, and you might be able to take advantage, knowing the approach, the calculation of the federal income tax. Take advantage of this and fully understand the calculation. Maybe you want, if you're making so much money now, you want to take some, make more contributions to your retirement fund, and that way you reduce the taxable income, right? Eventually you have to pay later, but maybe it's better later than now. So the more you know about taxes, the more you do tax planning, right? Take advantage of all the features and benefits. Now, okay, so we know that we have a goal. We know the basic financial mathematics. Now it's about investing, right? The way we are going to invest, we need to fully understand first that the higher the risk, I mean, you can see that there are different securities. We can have from a checking account to treasuries. Treasuries are government bonds, which are very short or very low risk, to high-tech companies. Like, so if you invest in Tesla, for example, now, what is the future of Tesla? Very promising, or maybe not, right? So you're taking a risk, higher risk than investing in government bonds, right? Obviously. So the return goes hand in hand with the risk. If you're willing to take higher risk, obviously you're going to get compensated with higher returns. That's usually the case. But before you can start investing, you need to make sure you have a very solid foundation, right? So you need to make sure you have a plan, but you have the financial records, you have enough insurance to cover maybe death, maybe disability, health, you know, your assets or property. So yes, it's a very comprehensive, I mean, all these areas, parts in personal finance are all together, are all interconnected, right? So yes, insurance is going to be a topic we cover by the end of the class, but look at this. It says before you can start investing in risky things and for the long term, you need to make sure you cover all the bases, right? You have a strong foundation before you can take risks, right? So once we start investing, we need to have the goals. What exactly are we accumulating wealth? Is it the short term, long term? That's a time horizon, right? So what exactly are the goals? For what period? Short term, long term? Are we okay with taking risk, right? Are we aware of the risk involved in our investments? And we also need to understand that over time, things will be more expensive. So we might have to save more to make sure we have enough to pay those things, right? Because let's say tuition college, right? So we cannot use the current prices. Tuition is kind of growing faster even than inflation, right? That's why college is getting so expensive. It's really, really changing every year and really quick, you know? So, so tools for saving. How are we going to save? Well, first of all, probably we start with the saving account. Why? Or very short-term accounts. Saving account, checking account, money market account that pays a little bit of interest, or a little bit longer, certificate of deposits. CDs. Well, these are the typical, I mean, your check will be automatically deposited in a bank account, checking account, saving account, and you need to write checks to pay your bills, right? So this is for sure one of the first steps. There are many choices, obviously, many, but these are the basics. Saving accounts, checking accounts, money market accounts, and CD. So some of these, I mean, we are going to learn way more choices, but we're going to look at the advantages and disadvantages of each one. Some of these are more liquid than others, able to withdraw money, write checks, insured by the FDIC, the Federal Deposit Insurance Corporation. That's the corporation that guarantees up to $250,000 per person per bank, right? So those are the things you need to pay attention, and we are going to teach you about the differences in these vehicles, right? We're also going to exercise balancing your checking account. Even though it seems so simple, it's kind of an accounting exercise, right? Why the current balance in your checking account is different than your checkbook, right? Because you have been issued checks, they haven't been cash, or you've been paid and haven't been credited yet. So there might be differences between what you see in your checkbook, that should be the balance, and the actual balance if you go to the website of the bank, right? Now, once we pass this process, because when we were dealing with these saving accounts, maybe we're building an emergency fund up to, I don't know, like 3, 4, 5, 6 months of expenses. But once we pass that point, we start thinking about long term, right? For buying a house, sending the kids to college, or retirement, and we start considering bonds. Bonds, it's basically a loan made to a corporation or the government, and they promise to pay this back, including an interest for using the money. It's safe for the most part, and then you have stocks, which is not a loan, but ownership. You own the company. You typically get paid dividends, the profits, and then depending on companies, some companies are growing really quick and the value of the stock will go up. Other companies like Walmart, for example, are well established and the growth will be minimum, but some stocks will give you more dividends, other companies or stocks will give you more capital appreciation or change in value. And then we have, which is the most recommended approach, mutual funds. Mutual funds are pool of funds, so companies, financial institutions that take cash from individual investments from individuals, and they invest in stocks that typically run by professionals and well diversified because they have many securities. They invest in 50, 100 shares. And for you, it's a great benefit because for a little bit of money, you don't need to put a lot of money to invest in mutual funds. You immediately gain the benefits of that is run by professionals, that is well diversified, that they do all the paperwork or clerical work or tax forms for you. So plenty of benefits. We study also these investment approaches, more active, less active. Obviously that we're gonna invest for retirement, and the government gives us a couple of vehicles that are tax shelter or tax advantages, right? So the government gives us the benefit of paying lower taxes, delaying the payment of taxes, or even not paying taxes at all. So we should take advantage of these vehicles, and we're going to learn about these vehicles. So look at the difference here between somebody who starts at 20 years old, investing for 45 years, if they retire at 65, versus somebody who starts at 40-year-old, only investing for 25 years. So the balance in your retirement account is going to be significantly different, right? Look at the earnings. The purple one is your contributions. The green one are earnings or profits on your contributions. And then the green, here is the total, right? Now, here is an example I always bring. It's maybe from a different book, but these are twins, Selma and Patty, and they have the same age, so 10, 20, 35 years before they retire, right? So look at what happened. One of the twins contributes $20,000 a year, or $2,000 a year over 10 years, right? So over 10 years, she made $20,000 contribution, but she did it in years 1 through 10, very early, okay? And nothing ever again. That's it, $2,000 a year for the first 10 years. And the other twin doesn't do anything during the first 10 years, but then starting in year 11 through 35, so basically for 25 years, she contributes $2,000 a year, right? So that's $50,000 total. So she contributes more than twice what Selma did. And still, at the end, she ended up with less, 146 versus 198, assuming that there's an 8% return a year. Why? This is a perfect example why you need to start early, because even if you just invest or save for 10 years, it will be a lot after earning all these return on these investments, right? It's difficult to catch up later, right? You get older, you only have a few years left, and you try to contribute more than twice, and still it's not enough. So the earlier you start, the better, right? So this is the perfect example how contributing more than twice, you still get less, right? Because she waited too long. Okay, so I mentioned that the government give us some breaks, and these are called the tax shelter vehicles, right? So the 401ks, IRAs, or individual retirement accounts. So we also need to learn about this, the differences. There are a couple of them, at least 3. One is the traditional IRA, right? So you make contributions before tax, right? So these contributions are taken from your payroll check, and you basically pay lower taxes now. And then when you withdraw the money from the IRA account, you will have to pay taxes. Okay, so that will happen when you retire, at least after 59.5 years. All right. There's an alternative called Roth IRA, which you make contributions after taxes and you never again pay taxes. Okay, so there you have one that you make pre-tax contributions and one you make after-tax contributions. So we need to understand the differences and which one is better when you start working in the first couple of years, which one is better later when you make a lot of money. And there's also the plans sponsored by your employer, right? By companies, called 401k for taxable companies and 403b for tax exempt, like universities, right? We have a 403b for faculty. Okay, so we need to understand these investment vehicles that have tax benefits. And another way of investing is through a house, even though a house is, I would say, an expense, right? Because you need to live somewhere, and if you don't buy it, you lease. But at the same time, it's an investment. It forces you to save. There's also appreciation usually. I mean, you buy the house for a value and over time will increase. And we also need to understand this process, right? So from down payment, mortgages, points, inspections, title insurance, title search, all the closing process and where to look, how to select the house because of what goals, like are you looking for a school district? Do you wait commuting, you know, what type of life, and different choices from apartments, condos, single units, and we look at the decision in more detail. We spend a whole chapter on buying a house and also a whole chapter on buying a car, you know. Now, in order to qualify for a mortgage or a car loan, they're gonna check your credit score, right? So there's something we need to spend time analyzing the credit score, right? And it's a credit report, right? The credit report, there are companies, there are bureaus that collect data on your credit history, right? Whether you pay your debt on time and how many credit cards you have, how much balance you have. And that credit score translates into a credit score, right? And a single number, a 3-digit number, right? All the way to 800. So depending on your credit score, which it's kind of a summary, it's like a GPA, right? A summary of your academic performance is the GPA. The credit score is kind of a summary of all your financial history, right? Whether you have late payments, delinquencies, defaults, you know, like anything like that. And including, I mean, the utilization rate, which is if you were approved like $10,000 in your credit card, how much are you using? Well, if you're using almost all your credit, it's gonna affect you in a negative way. If you're using a little bit, then you have margin. You can still increase the debt. So what factors get into the credit score? Well, past payment history, how long, the length of your credit history. So that's why we recommend that you never cancel a credit card, right? Or an old one, your first one. So one day you're gonna get your first credit card. Never cancel that because that's a significant factor in your credit score, right? The amounts, yeah, the utilization, the type of loans you have, and how many new credit you have recently. What are the consequences? Well, here you have an example. Based on your FICO score, which is one of the 3 companies, Meridian, FICO, you know, the higher the credit score, the better. So not only, look at this, not only you have better chances of getting a loan, but also getting a lower rate, right? So the higher the credit score, the better the chances of getting the loan and the lower the interest rate. Even more, insurance companies create an insurance score, right? But it's based on your credit score because they say that it's highly correlated or is very connected. The probability of making a claim with the insurance company are highly correlated or similar to your behavior with debt, right? So it's very important to keep track, to build credit and control the debt in order to have always good credit score. So factors to consider, obviously your age, job, marital status, education, all those things will be factor, excuse me, these are the ones that are not factor, right? There's no discrimination for age, ethnicity, marital status, but it's all based on your activity, whether you miss a payment, how much debt, right? So those are the factors that matter. So what can you do? Right, so you can start early enough opening a credit card, right? Sometimes credit card companies won't give you a credit card. So what else can you do? Well, there's something called secure credit card. The secure credit card, you basically make a deposit of $500 and they give you a credit limit of $500. So basically it's your own money. That if you don't pay the $500, let's say balance, they take the $500 you put as a deposit. So it's a start. After a year, most likely you will get an offer to open a regular or unsecured card. That's it. Start like that. Start with a secure credit card, then move to an unsecured credit card. Don't close it because it's part of a factor, right? We talk that payment history is one of the most important, right? And the length is more important. So never close one. But even on regular basis, you need to make sure you don't miss a payment, that you are within your budget, try to solve any mistakes because you're entitled to get one report a year from every company. And if you find that there's something wrong information on wrong name or wrong credit card, you can dispute those things and try to correct the report. Now, another issue, right, it's whether you're ready. If you're organized, if you live within your means, if you have an emergency fund, if you have your records, if you're insured, the foundation, what we call foundation, then you're ready to take that. And if you're going to take that to buy a house, a car, electronics, furniture, whatever you're taking credit for, evaluate alternatives, evaluate the cost, right? The interest rate they charge you, the fees, the finance fees or penalties, right? So stick with the budget, don't miss any payments, have an emergency fund, keep track of your credit cards, make sure you don't go all the way up to the approved balance, check your credit reports once a year, right? And check the cost of these loans, right? So if you live within your means and you have a budget and you're monitoring your expenses, hopefully you have that under control. But it's very easy to get out of control. There's usually checklist of tips when signs that you are in trouble, when you don't know exactly how much is the balance on your credit card. If you don't know the fees or interest rate you pay on the credit card, if you receive letters about lenders that you were not sure. I mean, anytime this is going to get completely out of control because you're going to take a loan to pay a previous loan and interest rates are going to go up and fees. And so it's going to be kind of getting out of control, a snowball. Now, when you take loans, we are going to also analyze the payments, right? So typically a mortgage or a car loan, you pay the same amount of money. It's called amortized loans. You pay the same amount of money every month, and that payment could be 48.31. And each payment, you're gonna have part that goes to cancel the loan and part that is pure interest, right? So this looks like the amortization schedule for a mortgage or a loan, right? So it's a 12-month loan for a $5,000 paying 14% of interest, right? So you see the monthly payment is always $448 with 94 cents, but each month the interest component or the principal component is different. So we do this exercise. We try to figure out the monthly payment, the balance at the end of every any possible month or year when we talk about mortgages. So we need to understand the process of a debt, right, or a loan. We also evaluate saving for college, and we look at saving vehicles with tax benefits, the plans, the 529 plans and at different state level, at the state level in different states, or the federal government called federal or the Coverdell accounts or educational IRA. So we also, at some point, we learn about saving for college, how college gets so expensive, how to save and take advantage of loans, federal loans that are subsidized, or what the difference is between federal loans and private loans, right? So who qualify, who doesn't, what are the benefits, what are the risks, how to repay, the differences in interest rates, resets, or a time that you don't have to pay the first 6 months or stuff like that. By the end, right, so we put together a plan, we have the emergency fund, we've been in setting the long-term goals, we have been investing in bonds, stocks, mutual funds or pension plans, right? And now that we're building up wealth, we need to start thinking about protecting it, right? So we're gonna look at different type of insurance, and insurance is basically a protection against devastating events, right? Like sickness, death, accidents, liability, right? Because that can derail your plan, your future, right? Your financial future. So for example, you need to have auto insurance, and we talk about auto insurance, how standard they are, what are the policies, the deductibles, um, um, and clauses, what means this clause or that clause, and who pays in this event or that event. We look at home insurance, different types, from rentals to detached properties to commercial. So the different type of, and always we also discuss pros and cons and how to make it cheaper, right? What can you do to make auto insurance cheap or cheaper? How about home insurance cheaper? What features you can put on the house? We also discuss the health insurance to protect for this is kind of a big deal now, because health insurance, health expenses are getting larger and larger over time, right? Not only the technology is getting better, and at the same time the treatments are more expensive, but also the malpractice or lawsuits filed against doctors, and all the system get rigged and getting more expensive over time, right? So we also need to understand the different plans, the different costs. So we spend a significant amount on understanding health insurance. We also discussed the Affordable Care Act, what is commonly known as Obamacare. What were the significant changes made at that point in time? And then we talk about disability insurance in case you are not able to work, definition of when you cannot work. I mean, also life insurance in different ways, whole, with saving components or not, long-term care insurance, just in case you cannot work for more than 6 months. So there are different type of insurance that we need to look, from property, life, health, liabilities, and not many people are knowledgeable about insurance and the features and clauses and types. So it's a good exercise, even though it's a little bit too technical, close to business law, but it's kind of important, especially if you try to save money there. Now, finally, there's a bunch of resources. I mean, we cannot cover everything. We cannot go in too much detail, but there are plenty of resources you can use to read or get information, from consumer protection agencies to regulators to the federal government, Federal Reserve, Treasury Department, IRS. So plenty of places you can go for information. And here you have even the classification on personal financial education, if you're trying to learn, on for youth, or on budget, on debt management, on consumer protection, right? So different kind of sources or approaches. Also books. I mean, I strongly recommend reading this guide, right? The one that we were talking about. And the Federal Reserve has plenty of material. The Federal Reserve has the largest staff of researchers, right? So they have a bunch of economists doing research at every level, macro level, regional level, different industries. So they provide a lot of information and reports and research, right? So I like this slide about the people who were the examples used in this guide through the chapters, and that's when you get the credits and questions. Anybody has any question about the class, expectations about the class, or if you're interested in taking the class, any comment is welcome. Anybody? how much question? So how much would you say people should allocate to a retirement account from their check? How much would you say people should have in an emergency fund? Well, the emergency fund, let's start with that. So what is that for, right? So in, without being drastic or pessimistic, I mean, the emergency fund will cover a visit to the doctors, to the ER, to fixing a car, or no. So those are low amounts usually, couple of hundreds, a couple of thousands. So unless you get laid off, and that's the key. That's the drastic one. They recommend, it's not, I mean, if you think from zero to an emergency fund, you will look like, oh, how do I get there, right? It looks like a lot. So if I tell you 6 months of expenses, well, if you spend, let's say $2,000 a month with lease, the rent, which could be even more, food and rent and this and that, $2,000–3,000, right? Multiply that by 6, and we are talking about $15,000 to $20,000, right? That should be the balance in your checking account, just to be safe. And you say, well, I have nothing now. How do I get there, right? So again, from 0 to 6 months looks like impossible, but the idea is that you start a couple of hundred a month, or I mean, whatever way you can. But usually they say 6 months because what if you're laid off, right? You need to continue. I mean, you will downsize in some way, but even you might have to invest, applying, visiting, interviewing, right? Maybe getting some skills you don't have. So 6 months will be a good goal because you need to get the new jobs, you know. How much you should allocate to retirement? Well, you need to read these about these vehicles, right? The Roth IRA, the IRA, the 401k, to understand the benefit, right? How much benefit you have using them. The more you can save for retirement, the better. Some people, I mean, there's no single answer there. So some people save 5%, some people save 10%. It's like exercising, right? If it doesn't hurt, it's not doing much, right? So if you don't stretch it, if you don't save, and you don't feel the pain, right, of saving, probably you're not doing enough, right? So there's no single answer, but you should try, right? If it doesn't feel like you're saving, or is, I mean, that you need to cut expenses here and there or monitor your expenses, you're not doing the best, right? So then the question is, should I reach $1 million, $2 million, $3 million by the time I retire? That's a different question, right? So there will be different styles, you know, lifestyles when you retire, but it will be ideal if you can save, I would say, $500 a month, you know, that would be great. Let me give you just a quick calculation. So by $500, okay, so let me do a calculation. If you put $500 a month, which is kind of good money, let's say 5% a year divided by 12 interest rate, and let's say you're 25, 40 years, 40 by 12, it's 480 months. The future value will be 700,000, or kind of like $1 million. Okay, so that 5% is kind of low, but $500 a month, 480 month, 0.42, compute future value. Yeah, so if you just put $800 a month, you're gonna have at 5% return per year, $800,000, maybe more get to $1 million quite easy. There are plenty of apps now. I'm not familiar with all the apps, so I wouldn't go with the spreadsheets. Spreadsheets sounds like my age. I'm 47, so spreadsheets sounds like an old-fashioned person. Nowadays, you can have apps. I mean, I don't remember on top of my head the apps, but we mentioned in the personal finance book, there's a couple of apps mentioned about tracking your expenses. Yes, nowadays there are apps for everything. So I would go, instead of a spreadsheet, go with an app, because you have your cell phone in your hand every single day, all the time. So it's going to be much easier to enter the amount in the cell phone or scan a ticket, way more friendly, and the transfer, the way you handle this much easier with an app than a spreadsheet. Spreadsheet, you need to open it, classify in a cell, take the thought. No, it's an old fashioned. I mean, I probably do that a lot, way more than young people, but with apps, you're gonna reach the same result in a much easier way. Yeah, you need to look for apps. And there are plenty of them. You're welcome to take the class if it helps to reach the credit hours needed for graduation. It can help you with your life. And if you even need the quantitative component, it counts for that too, right? So you're welcome. We offer the class in the fall, spring, and summer. So every semester. In the summer, it's not even a summer 1 or summer 2. It's kind of a 12-week. We made it like a regular semester, so it doesn't feel that we are rushing through the class. So we have a 15-week semester in the fall, 15-week semester in the spring, and a 12-week semester in the summer, right? So take a look at the class. All right, guys, thank you for your time. Feel free to email me or ask questions anytime. It doesn't hurt, right? It doesn't bother me. Feel free to email me. All right.